Spartans! What is your profession?
Hi traders, Mark here from Flipside Trading. Now we've got the basics under our belt of what options are and the type of trades that we're actually going to place. We're going to talk about what the notifications look like and then actually how to execute those on your trading platform. So let's look in more detail about what we're talking about. Well, the first thing is we have to talk about is how many contracts we're going to buy, right? We need to talk about the risk management and the position sizing. The next thing is we have to look at the options chain. Okay, there's some orientation and nomenclature we need to look at to make sure you know the mechanics of how to open and close trades. Then we'll take a look at a bunch of different text messages from all our different three types of trades that we have. And so you have an idea of how these messages are going to be, and then we're going to actually show you how to execute these types of trades live on a trading platform. All right, let's jump in and talk about risk management and position sizing. Oh, one too far. Sorry, guys. All right. Trading. There's going to be winning trades. There's going to be losing trades. Okay? That's just the nature of the game. So what we have to do, you have to be able to manage risk and you have to preserve your capital, right? That keeps you in the game. That's the first priority of all traders, okay? Because the market, they want to take your money from you. They're absolutely ruthless about it. They want to go in, rip your head off, put the money in the pocket, and leave you. They don't care. You are a totally faceless person to them. They have no inclination or empathy for your position, your value, of what you bring to the table. Now, what we want to make sure is that the risk of each trade should be no larger than 5 to 10% of the portfolio. All right, this is to ensure that you're not too heavily overweighted in case the trade goes against you, it just knocks you out of the game. All right, make sure that you follow these types of limits. All right, do not go all in, do not be a plunger. That's the first and fastest way to go ahead and blow up your account. We are not going to set stops. As we've talked about before, every trade has a defined risk, right? If we're going to buy a call or a put, it's the debit. If we're going to buy a debit spread, it's a debit. If we're going to sell a vertical, well, then we know that that risk is basically the width of the spread, okay? The reason is that the market with options, with all the algorithms, computer trading that goes on, all these stops are more or less set in the same place, and that's an area of liquidity. So they like to search things out and spike the price down to go ahead and suck that up. So what does that do? That knocks you out of the trade, generates commission for them, okay? So we avoid that by not placing stops, okay? The next thing is, in order to figure out how to gauge risk, we have to realize is not everyone has the same size account. Some people may have a discretionary account, right? Some money they've saved, they want to go ahead and parlay that into larger income. And let's say that's at 25K. Some people maybe have a rollover IRA and they have, 250K in that account. So we need to normalize that. So we're going to normalize that with this table here. And basically you're going to see that in our wealth trades at a starter position, okay, is going to be one contract. Now, one contract or starter position for someone with a 25K account is one contract. With a 250K account or a 50K account, maybe it's two contracts, maybe it's three. All right, if it's a real solid setup, looking really good, I think this is something that we have a good, really good confidence. Hey, 3 to 5% of your portfolio. Even though I say 3 of a smaller account, hey, 2 contracts is fine. Stay in your comfort zone, especially at the beginning. If you want to do more than that, go ahead. 3, 4, or 5, that's great. If I say it's a gold setup, it'll be 5. The same thing for the income trades, right? 5 is kind of your starter position, but feel free to do less. 10 is your confidence, but you don't need to do 10. You can do 8. And if your account allows it, you like it, you can do 15. Same thing for your gold setup, right? I'm very confident. We're going to have this kind of 85% confidence level. Trend, everything is moving with us. So we're going to go ahead and have 15 contracts. You don't need to do 15 contracts. You can do 5 contracts if you want, all right? Position size it. Stay within the levels of your account portfolio. Do not blow it up. I cannot overemphasize that enough. Okay, next thing is, once you know and you get a message, you're going to have to go to your trading platform and you have to take a look at that trading platform and open the options chain and execute that trade. Okay, so the first thing to realize is that all optionable equities, okay, and indexes have at least monthly options expiration. Okay, and you can see monthlies because they're here. There's no nomenclature by them. These are the monthlies, right? There's February monthly. There's the March monthly, right? And you can see down here, okay, we got just monthlies after that. We don't have weeklies, okay? That's kind of the way it works. So the key thing is that monthly options expire every third Friday of every month at market close at 2 o'clock, okay? We also have weekly expiration. We'll take advantage of those quite a bit, okay? It gives us more flexibility. We be more granular and more precise with our trades, okay? You can see that it's marked here, you know, by the weeklies. Now there's also more heavily traded products like the SPX and SPY, which are indexes on the S&P 500. They also will have, instead of just weeklies, they will have expiration on Monday, Wednesdays, and Fridays as well. We will take advantage of those, right? We'll have some credit spread trades that we'll put on Tuesday and they'll expire on Wednesday. All right. Now, the key thing is the first thing you want to do when you see the message, okay, example, we're going to buy to open, right? One contract of AAPL, which is Apple. This tells you right here the expiration series. All right, let's just focus on that. So the first thing we're going to do, you're going to come into your search box and you're going to type in the symbol of the underlying, in this case Apple, AAPL. You hit enter. It's going to open up and show you all these different options expirations choices. It's going to tell you that we're going to open 16 February of 2018. There we go. We're going to select that series. How do we select it? We just click that little arrow and it's going to expand it and we're going to see a bunch of new information. This number 10 just tells you the number of days to expiration. Remember, this is important, right? Because we're going to take advantage of, you know, theta decay, or we're going to go ahead and make sure that we protect ourselves against theta decay. So we're going to use that as a gauge to figure out how far out from expiration that we should actually place the trade. Okay? There we go. Pretty simple. So step 1, choose the instrument. Step 2, choose the option expiration series. All right. Now, the first thing, remember, we said we're going to buy. Okay? So we're going to go ahead and buy at the ask. So we sell at the bid. Every time you open the options chain, you'll see this. You have bid and ask. All right? This is what's known as the market prices, right? If you want to buy it, the market price is $8.65. If you want to sell it, it's $8.30. We're always going to try to sell in between the bid and the ask, right? We're not going to give the brokerages and the market makers useless money, right? We're going to be more in this mid price here. Next thing is that this is divided on two different sides between puts and calls, right? So the calls is always here on the left-hand side. The puts are always here on the right-hand side. So we're here and we're going to go ahead and we're going to buy the call. So we're going to focus ourselves on this left-hand side. We know we're going to buy the 155 call. Oh, so we just look down here at our different strikes and we find the 155. Now we say we're going to buy it at 855, which is in between, okay, at this point in time, between the bid and the ask. That tells you what to do. Notice that when we buy a call, okay, we're buying it with what we call in the money, okay? Right now, Apple is trading at 163. We want to buy the 155 call. We want to buy that in the money. We want to do that in order to, it basically reduces the extrinsic value which means that we have less theta expiration. Okay, so basically what we're doing is we're going ahead and we're offsetting that theta depreciation of this asset when we buy it by buying it further in the money. But notice, the further you go in the money, the more expensive these calls are. So therefore, we kind of balance that out. Okay? So now calls, we expect them, right? When we buy a call, we expect that the price to increase. So you can see here that maybe our target is like 175, and it's going to go this way. And so that's where we're going to be looking. Now look at, these are much less expensive because the probability of reaching that may be pretty small. Okay, so here's what we do, just to kind of recap. Okay, we know we're going to buy. We know it's going to be between, therefore, the bid and the ask. We know it's the February 16. Okay, we have it here. We know it's the 155 call. All we're going to do is we're going to click on this, and it's going to go ahead and provide us an options order, which we'll look at in a second. Okay, here we go. Options order. We want to go ahead and buy this, so we go ahead and we click it here. You just basically left click right here on the buy side. All right. We want to buy at the midpoint between the bid and the ask. As we said, once you go ahead and click that button, you're going to get an order entry screen right here. That order entry tells you everything you need to know, right? One contract, Apple, tells you the option expiration series. Here's the strike price, 155. Tells you right here, you'll see it in your message, right? We're going to buy a call. Now, this midpoint is the midpoint between the bid and the ask. Now, it's not exactly as it is here because there's a time delay between what we're looking at when I created the slides and when I got to this piece. Remember, the market is always fluctuating. And here's the natural. Here's the marketplace, the market price. We want to buy between the mid and the natural, more closer to the mid size. So if I look at this, it's like, hey, you know what? I want to buy this about 855. So I would just go up here to my plus or minus, and I would click it till I got 855, and I would go ahead and hit the confirm and send button. You either hit confirm and send, or in some cases, some platforms, it'll say preview. What that does, it gives you the idea to say, okay, what is the trade? What does it look like? You have a summary, so you can just review it before you go ahead and actually execute that trade. Okay, so let's take a look at the messages, a bunch of different ones, and then we'll go ahead and look at this live and how to execute these trades. Long call, right? That's going to be bullish, right? We're going to buy it to open. 1, starter position, the symbol, Netflix, the expiration series, all right? So step 1, what you're going to do, you're going to go back to your options chain. You're going to type Netflix in the search box. You're going to scroll down. You're going to find this option expiration series, and you're going to click the little arrow to expand it. Then you're going to go to the strike price at 260, and you go ahead and buy that. You're going to go ahead and basically left click on the ask, and it's going to bring up that options order window. Okay. Then you're going to go ahead and you're going to look to buy this between the bid and the ask, somewhere close to 910. A couple 10, 20 cents either way is going to be fine. Remember, the market's dynamic. It'll bounce around. It may come back to you. But if it runs away with you, don't worry about it. There's another trade right around the corner. And look, we tell you it's a bullish play, and the first target, 183. Puts is the same way. The only thing we're doing here with the puts is we're looking, right? We're looking to go short, but we're still going to buy it, okay? 3 to open. Here's your symbol, Facebook. Go ahead and put that into the search box. Find your option expiration series. Find the strike. Now the puts will be on the right-hand side, all right? We know that we're going to buy between the bid and the ask, right? So hopefully somewhere around 540. Here's your target. Now when we look at vertical spreads, remember, a spread is a combination of buying a call and selling a call, or buying a put and selling a put for our purposes. Okay, again, Number of contracts, solid, right? 5. Go ahead and position size accordingly. Your symbol, right here is Apple. Type that in your search box. Same thing, find your option expiration series. Okay, now we have a 155, 175, which means that we want, and we're thinking about this, we're thinking about, hey, the stock's at 155, we want it to go to 175. Here's the price that we're going to go ahead and purchase that spread at. So we're going to tell you straight out, you're going to buy the 155 call and you're going to sell the 175 to limit the risk. Bullish play in Apple. If this nomenclature is confusing, don't worry about it. We will decipher it for you here on the back end. Put debit spread. Okay, bullish play. Buy it to open. Again, number of contracts, symbol, expiration series. Hey, it's at 1055. This is a little, we want to go down to 1030, right? But we want to go ahead and buy that for about 680. But we go ahead and decipher that for you. We're going to buy the 1155 put, and we're going to sell the 1130 to limit risk. Okay? Bearish play on Google. Step-by-step cookbook instructions. Call credit spread. Same thing. Hey, we're going to sell to open. Okay? A little bit different. But otherwise, everything's the same. 10 contracts. Your symbol, expiration series, 375 to 380. Okay, we're selling a call, right? So that means we're quote unquote bearish, so we want the stock price to stay below 75. So we're going to go ahead and sell the 375, and then we're going to buy the 380 to limit the risk. Okay, we're going to sell it for 30 cents. Expires in 2 days. We want this to expire worthless. We want to keep all that. Same thing with a put credit spread. Okay, this is going to be bullish. We're going to sell it to open. Right? Number of contracts, 10. Even. Position size accordingly. Symbol, GS. Expiration series, 230 to 235. Which means that we want this stock, right, to stay above 230. Okay? And we're going to sell it for 65 cents. So we're going to sell the 235. Buy the 230 for protection to limit the risk. Hey, this expires in 37 days. We're not going to wait around and wait for this to expire. Worthless. We're going to go ahead and set a good to cancel order. Okay? So hopefully this is when the spikes can help us, right? We want to get out of a trade in the positive side to close at 30. So hopefully, within, 10 or 15 days, we'll hit this strike and we'll be out of here. Okay? Very straightforward. It does take some getting used to, right? That's why we're going to practice. That's why when you start off, limit your size. If you have questions when you place the trade, text me, call me. We'll get on the phone. We'll help you right away. All right. Besides opening trades, you also have to close them. So it's going to be roughly the same type of thing, right? It's going to tell you, sell to close, right? It'll give you the same tray up before, right? How many contracts, right? The strike, this will be the same thing as the open. It's going to tell you what the new price will be, right? Remember, I think we bought this one for like $9.10, so we're going to sell it for $10.60. So we're taking profits, okay? And we're going to go ahead and maybe we'll leave one, maybe we won't, okay? As maybe we'll leave a run or a tight stop if we had more than one, okay? Same thing, sell to close. Okay, a debit spread. Note, the way we're going to do this, and I'll show you how, all right, you'll be able to close this as a single transaction. You're not going to have to do a separate piece to buy the first leg and sell the second leg. Maybe we'll give you some updates. Hey, here it is. It's Friday. It's option expirations day. We're going to go ahead and tell you, hey, things look really good. We're planning on letting this expire worthless. It dropped 4 points. We're not expecting to threaten a short strike, so therefore we're hoping to keep all this 30 cents. Don't need anything to do. We're going to tell you in this case, remember, on this Goldman Sachs trade, this had 37 days to expiration. Okay, it was at 30 cents. We want to close this as a good to cancel order okay, at 30 cents because I think we sold it for 60, right? We're selling it for half. Now, all I'm going to do is notify you that order was hit, and therefore we hit our profit target, and you should be flat those positions. Okay? So that's the mechanics of how you do it. Again, it's very, very cookbook. I'm going to pause it here for a second. I'm going to pull up my platform, and we're going to talk about some different trades and show you exactly how it looks. Hold on 2 seconds. All right, we're back. We have everything all set up. So the first thing is you come to your trade tab, right? And in this case, here's our little search box. So what we're going to do is say, okay, that we want to go ahead and we're going to trade some Amazon. And we're going to trade Amazon, and we're going to look at all the different options, expiration series, and we decide that we want to trade the monthly. And based on we're trading the monthly today, we look at Amazon, and we look at the chart, and let's say we're going to be bearish because today it's getting smoked. It's already down 20 points. So we want to go ahead and buy a put. Remember, this left side is calls. This right side is puts. So we're going to go ahead and buy some puts, and let's just say it's a starter position. So we'll just say it's one contract. We'll do this here on my simulated trading account. And we're going to go ahead and buy the 1545 put. So let me just... So we're going to buy the 1545 right here. Right? We'll go ahead and left click that. It's going to say buy. So now I just want to go ahead and just want to buy one of these. I'm going to take a look, and you see we have the mid price and the natural price. I want to buy closer to the mid price because this is the market price. I want to pay less for this, right? I want to pay $54.95. I want to pay about 53, probably getting in there. It's moving around a bit. You can see moving around again. The price is jumping back up. We're getting some good movement. So let's go ahead and say we try to buy it. We hit the confirm and send button. It tells you. We'll take some. Tell you what your max profit can be. Tell you what your max loss can be. Right? Max loss is the overall debit. Right? Gives you your order description. Does that sound good? We'll go ahead and hit send. Boom. Filled. We got one Amazon put, and we'll see whether or not we'll come back to that a little bit later. Let's say now that we wanted to trade another entity. Let's say that we want to trade Netflix. So we type Netflix in here. And again, let's go ahead and look at the Aprils. And let's assume that we want to go ahead and make this a put debit spread because Netflix is also down today. So we go to the put side here on the right hand side. We say, okay, we want to go ahead and we want to buy the 315, and it tells you to sell the 300. We think it's going to 300. Right now it's trading, as you can see right here where my cursor is on the upper left, at 311. So what we want to do, we're going to buy it. So right, this is really nice, right? So here on the ask, it's buy, but you can see it says buy. I'm going to right click. I'm saying I'm going to buy vertical. So now I'm going to buy the vertical. I know I wanted to buy, okay, that's plus 10, the 315, and this minus 10 means I want to sell. I want to sell the 300s. So I can go ahead down here and I can sell the 300s. It tells me that we're going to buy this for $6.95. You want it between the bid and the ask. And right now it's kind of pinned here right on the mid. Probably need to put it a little bit more to the center, probably around $6.95. Let's give that a shot. And 10 contracts is too many, right? Let's say it's a nice solid position. We'll go ahead and say it's 5. Okay, you can see it move. We'll have to pay up for a little bit. Must be moving down. We'll try $7. Confirm, send. Boom, we're in. Okay. Now let's say that we've gone through, like, buying a put, right? Buying a put debit spread, buying a call debit spread is the same thing. So now we'll also talk about verticals. So let's go to verticals. Let's go now to SPX, which is the S&P 500, right? Go ahead and click that in, and we want to go ahead. Yep, here it is, SPX 500. And we look at these. Hey, we want to go ahead and look at something that expires tomorrow, right? March 28th. Again, okay, the XPX is down, so we definitely want to call credit spread. So we're saying, okay, we want to sell this 2680. Let me go ahead and highlight that for you. We're going to sell the 2680 and we're going to buy the 2685 for protection. We go here. I'm sorry, I have to take it off screen draw in order to make this activated again. Okay, we want to sell the 580. So we're going to go ahead and left click the 580. We want to sell a vertical. Okay, 2680, 10 contracts. That sounds about right. $1 credit. Now they're not going to quite give us $1 credit, so we're going to say again, look at the difference here. Want to sell it between this natural and the mid, but closest to the mid as we can get. So we'll sell it for $1.05. We'll go ahead, confirm and send. It says sell the 10 vertical. All right, tells what our price is going to be, tells you what our max loss is, $39.50. Our max profit, $1,000 in this case. So we're going to hit send. Boom, we're hit. Now note, we're in a simulated trading environment, and a lot of things are going to happen. You're going to see that we're going to get filled right away. In normal trading on a real platform, live trading, I should say, this is still a real platform, is that it's going to bounce around a little while. It may take a little while longer. So now we're going to go back and we're going to monitor our trades, right? You can see that we have, okay, you can see all our orders that we had. We don't need to look at those right now, but look at our overall position. We have the Amazon. Oh, look, we already made 82 bucks on that. So let's go ahead and close that. That means that Amazon must still be dropping. So we can go here. We're going to right click it, and we're just going to create a closing order. And look, as we talked about before, even though we have two legs as part of a credit spread, let me show you that. Right? This consists of two legs. I'm sorry. This isn't the credit spread. This is the overall put. Right? Even though we have the put here, we're going to go ahead and sell that put. We're going to sell it for 155 bucks. So we're just going to go here, create the closing order, sell Amazon 1. Again, we're going to look to sell it between the natural and the mid. We want it close to the mid as possible because we want to sell it for the higher price. So we're going to sell it for, let's try to see if we can sell it for 53. Confirm and send. Boom, we sold it. Wait till that little piece goes off. We go back to our monitor, right? Shows us we have nothing left, right? No quantity. We sold it out, and look, we made 195 bucks. Hey, gotta love trading. Way to go. Netflix. All right, we want to close this out. We look at this position. Remember, this was a put debit spread. We bought 5 of these. All right. We want to go ahead. We're making some money here. We're going to go ahead and show you what the close is. You just come over. Hey, I'm going to create the closing order. I want to sell this vertical. I just click on that vertical. And you know what? So this is a put debit spread. I think it's going to run a little bit longer. We're going to take some profit. So maybe we're going to take some profit that we're going to sell. We're going to take 2 of them. We're going to keep 3 open. And again, we're going to sell between the natural and the mid. So we're going to move it back a little bit. Probably, it's moving against us some. Let's try $7. Confirm and send. Boom, we're out. We can go back here and we can see on the monitor piece, now we only have 3 contracts instead of 5. Okay, SPX. Normally, okay, this is a trade that's off tomorrow. What we would do, we wouldn't do anything, right? The goal is to let this expire worthless. But the same thing, let's just say that it's going against us. If it is going against us, what we would do is we need to close it out. We just go here, create the closing order. We're going to buy all 10. Okay, we're going to buy this back, right? Sold to open, buy to close. Now, we want to go ahead and buy this close to the mid as possible. So we'll say try 95. Hit confirm and send. Bada bing, we're close. Now we go back in that short demonstration, and we can see from our overall, okay, we made in that short time frame from when we placed those trades to until we closed them on the simulated account, we made $375. Okay. I wish it always works that way, but yeah, most of the time it does. Works well for us. So the key thing here is, okay, you have this as a reference. Not all the platforms are the same, but they are very, very similar. If you have trouble, right, call your help desk, look at YouTube, or give me a call. We'll help you with the mechanics. You then have to practice the mechanics, right? You're going to have to practice the mechanics either with very small, contracts, or in some cases, if your platform offers what's known as simulated trading or paper trading, I definitely suggest that you do that in order to get the feel. But that's how easy it is, guys. I mean, it's that mechanical, it's that cookbook, it's that rote. It does take time. You need to invest in yourselves, and then that investment will pay off. So catch you guys on the flip side. Again, any questions, give me a shout. All right, talk to you later.